Your teen requested a ride, but this time not from you. It's through their Uber teen account. You drive your teenager around, a lot, to their friend Jacob's house, their other friend Jake's house, to James's, to Jaden's, to Jalen's, to...
Mom? This is Jake's house, not Jacob's.
Now with an Uber teen account, your teen can request a ride under your supervision. They'll ride with a highly rated driver, and with live trip tracking, you'll follow along the whole ride to their friends' houses that all sound the same. Add your teen to your Uber account today. See app for details.
Bye, Mom.
Ryan Reynolds here for, I guess, my 100th Mint commercial. No, don't. I mean, honestly, when I started this, I thought I only have to do like 4 of these. I mean, it's unlimited premium wireless for $15 a month. How are there still people paying 2 or 3 times that much? I'm sorry, I shouldn't be victim blaming here. Give it a try at mintmobile.com/save. Whenever you're ready.
$45 upfront payment equivalent to $15 per month. New customers on first 3-month plan only. Taxes and fees extra. Speed slower above 40 gigabytes. See details.
Hey guys, welcome to this week's podcast episode for the Financial Freedom Podcast. I'm your host, Dr. Christopher, and I'm really happy to introduce our guest today, Dr. Robert Scranton. He's a practitioner based out of Utah, and today's talk is going to be talking all about the economic value of certainty, debt, common misconceptions about retirement accounts, whole life insurance. You delve into infinite banking and all these wonderful financial topics that are not always talked about. So, Robert, welcome.
Thank you for having me, Chris. It's a pleasure.
Yeah.
Looking forward to it.
Yeah. Tell people about your story, your background, and we'll get started.
Yes, I'd love to. So, an interesting journey through. I went to college and got toward the end of undergraduate, didn't know what I wanted to do. And so I was in the business college because I figured it was easier to get in high school into the business college at the University of Illinois than try to get into it after I got there, not being certain how I would compete grade-wise and so forth. So I was already in the business college and I had to pick a major. And my dad said, why don't you get an accounting degree? The world will always need bean counters. And so I got my degree in accounting and finance and went to work for the Florsheim Shoe Company as a financial analyst, did public accounting as well, filing tax returns, doing audits and so forth as well. And then I had a chiropractic experience that led me to go back to chiropractic school and to become a chiropractor. Yeah, that's my brief story.
Yeah, and it's quite interesting. And then you and me, we were talking backstage about our financial journeys. And what was interesting is a lot of these concepts that came naturally to you, you were surprised that a lot of your colleagues didn't know, and basically they were earning high incomes, but it was going all out the door. Tell us that story.
Yeah, absolutely. So just back up a little bit. I started following the kind of conventional financial advice that I think the majority of Americans are, because that's what their colleagues are doing. That's what their parents are doing. That's what their grandparents are doing. And around 2008 or 2009, it's just like, this kind of isn't working for me. These 401ks and IRAs, they just cratered and my accounts dropped significantly. And it was right around the time that my parents and their friends were retiring. And there was this unspoken thing. It seemed like everybody believed that if you could just save $1 million in those accounts, you'd have enough to retire on the rest of your life. But as my parents were right in the worst time frame and their friends retiring right around that time, and they saw their portfolios dropping by 45% right as they were leaving the workforce. And all my parents' friends were going back to work at Lowe's and Home Depot on weekends as fill-in help and so forth. I'm like, oh man, that's what everybody's doing. And that seemed like a disaster. And I'd started learning about this thing called the infinite banking concept. And when I first heard about that, I'm like, oh my goodness, like, how come I never heard about this before? Which made me even more curious and suspicious in a way, because I could not poke any holes in it. And when I realized what was really going on, I talked to my financial planner that helped me lose half my money. And I told him, I said, hey, I got this really awesome idea. I've been reading about something called the infinite banking concept. And he was just adamant, almost like I had just introduced him to the devil. And I'm just like, his reaction even was really shocking enough to me because I couldn't find any holes in it. I was frustrated because I thought, gee, with my background, having an accounting and finance degree, working in public accounting, filing tax returns, doing audits at company, working as a financial analyst, I felt like, man, with my background of anybody, I should have known about this stuff, and I didn't know about it. And the reaction of my financial planner, I thought, he worked for, at the time, I think it was Salomon Smith Barney, and their parent company was Citi Group or Citibank. And so a friend of mine turned me on to this thing called BOLI. It's a website. It stands for Bank-Owned Life Insurance, where you can literally look up any bank in the country and find out how much life insurance that company owns. So he was telling me how bad this was and how awful an idea it was. And then I went and looked up Citibank on BOLI, that website, Bank-Owned Life Insurance, and found out that 35% of all of Citibank's entire holdings, more than their stocks and more than all their real estate, they owned in whole life insurance contracts. And I thought, this is really weird. They're training their agents to tell me this is horrible, but yet they themselves are doing this to the tune of 35% of all of their entire holdings and so forth. And so I started going really into shut down my 401ks, IRAs, moved it all out, and started putting my money into creating my own bank. And as I talked to my dad, he's, oh, that's a really good idea. I'm like, again, Dad, why did you never tell me about this? And then he showed me a policy that I had that he got when I was an infant. And he said, oh, it's probably you're old enough. It's time for you to take this over anyways. But Chris, it was a policy that my dad was paying $50 a year on. Now, the numbers are small, but the concept is powerful. And that's why I wanted to talk about that. And that policy every year for that $50 deposit, as we say in the banking world, or annual premium, was growing the cash value inside that policy by $350 a year. Now, I don't think you have to be a super amazing mathematician to figure out if you put in 50 and they immediately give you $350 back, what kind of a return is that?
So
that's guaranteed because it's in a contract with the insurance company. And I don't know any financial planner that's going to give you that kind of guarantee or those kind of returns or ever see those in their entire lifetime. And then he told me another story about my great-grandfather, this concept of having your own bank. During the Great Depression, my great-grandparents were farmers. And what they used to do every year is in the spring, they would go to the seed company and they would get the seed for their farm on credit. They would plant and then harvest in the fall and take some of the proceeds and pay back the seed company. And that's how it worked year after year. But something happened in the Great Depression where the bank in their town and all the banks in their county, in their small county, went completely bankrupt. Everybody's money was gone. There was no banks to loan the seed company money. And the seed company was afraid to lend anybody credit because so many people were personally going bankrupt as well. So they couldn't get seed. But my great-grandfather, remember that he had this cash inside this 200-year-old financial instrument called a whole life insurance contract. And he was able to call the company and borrow some of the money inside that cash, go buy the seed, plant his crop, harvest the crop, sell the crop, and then pay back his own policy as his bank. And that's the only way that my great-grandparents were able to keep the family farm in the Great Depression. And so an interesting history going all that way back, but I've become a zealot about this ever since. And even myself, that's my favorite trip to take to the mailbox every single year is to go get my annual statement for my personal banks for the whole life insurance contracts and see the money that I put in there. If I put in 10,000, then I see that it's grown 17,000 that same year. That's 179% return dollar for dollar on what I'm putting in there and what I'm getting back. And there's no fluctuation. Every year the stock market has a hiccup or a bad cold. It still continues to perform that way every single time year after year. So that was probably more of my background even than we counted on, but hope that helps.
What's up, guys? It's the champ, Sean O'Malley, here to talk to you about Prize Picks. Prize Picks is the best place to win real money while watching football. Run your game on Prize Picks.
Prize Picks will give you $50 instantly when you play your first $5 lineup. You don't even need to win to receive the $50 bonus. It's guaranteed. Just download the Prize Picks app and use code SPOTIFY. That's code SPOTIFY on Prize Picks to get $50 instantly when you play a $5 lineup. Prize Picks. Run your game. Must be present in certain states. Visit prizepicks.com for restrictions and details.
As school germs return, rest easy. Clorox has got your back to school.
Ugh, you're back?
It is I, your kid's Jeremy Desk, and I've got things to say. I've been sneezed on, used as a tissue. There's chewed up gum under my...
Calm down. I'll get my Clorox disinfecting wipes.
Oh, and can you please get these sweaty gym clothes off of me?
School, am I right?
Clorox disinfecting wipes kill 99.9% of viruses and bacteria and clean hundreds of messes on hard, non-porous surfaces when used as directed.
Yeah, it's quite interesting. Once you realize that the whole financial system is based on salesmen making commissions, and basically the products that they are recommending is basically, I knew something was wrong when they were saying invest in mutual funds, and mutual funds are like dinosaurs. It's like high free, you just look growth, and basically they profit you and you take all the risk. And things like take out debt to buy a car, all this nonsense, this really bad financial advice. Once you become financially literate, you can do the things that you're doing. And a lot of my colleagues investing in real estate and fired their financial advisors, just so many, once you understand that. So really interesting. Talk about this idea, this economic value of certainty, which is quite interesting. I've been reading a lot of books on economics and like this idea where you're investing now for the future, but tell us more about this economic value of certainty.
Yeah, it turns, like we talked about, the traditional model that most of us have been taught, most of us learned. It sounds like we think a lot of, you may have been participating in that model at one time, just as I was, because you look around and everybody at work's doing it, your parents are doing it, your friends are doing it, and it feels safe, right? Even like the lemmings walking off the cliff, a whole bunch of other people do it. It still feels comfortable or safe somehow, in spite of all the warning signs. And so the economic value of certainty, right? What's really interesting to me is when I would ask, I was really confused asking financial advisors, you're saying that this is going to happen in the future, but the stock market could disappear. I guess the nice thing about the stock market, if you've got all your money in a 401k, at least it can't go below zero, but it could go all the way to zero. And that's one certainty, is that there's a lot of volatility, and everything that you are planning for retirement is 100% at risk. And even having your money in the bank, when we've seen all of these collapses with Silvergate, and I was at 4 or 5 of the top 10 largest banks in the country have failed in the last 5 months. And the FDIC will only insure your money up to $250,000 if they could even actually do that, because of fractional, lending. You put $100 in your bank and the federal government allows them to loan that out to 9 other people, that same $100. So your money's not actually even there. That's why all the banks went bankrupt during the Great Depression, because there wasn't even that insurance. And I don't know, the federal government could print money fast enough to cover everybody if all those banks failed today. So when they're making these projections about what you need to have when you retire and so forth, it's fairy tales. It's all just completely made up, because it's a logical impossibility to predict the future based off of uncertain numbers in the present.
Yeah.
It logically doesn't even make sense. It's not even possible. I think I'm surprised with the way so many industries are regulated around telling the truth and truth in advertising, that they're allowed to present those kind of Monte Carlo type of scenarios to people. And even if you were like my parents, you had that goal, I'm going to save $1 million and then I'll be able to retire. It used to be, Chris, you probably have heard this before, that kind of rule of thumb about you only ever want to withdraw 4% of that money to live off of, so that you don't run out of money in that retirement account. $1 million, that's only $40,000 a year. I don't know if that even puts you above the poverty line today, but now they revised that in the last year or so. And I've seen a number of articles in the Wall Street Journal and in Barron's are saying, oh, that number is way too high. If you want to avoid running out of money because of inflation and so forth, you better not ever take out more than about 1.9%, I think is the numbers I've been seeing most recently. So on $1 million a year, they're telling you can only ever access $19,000 of that a year. Who's going to be able to live on $19,000 a year? You can't even buy a car for that, for goodness sakes. So it's just a completely failed concept in the first place. Whereas what we're doing with the infinite banking concept, what's really nice is because everything is based on actuarial data. Actually, whole life insurance companies are far more stable than banks because of the regulatory scrutiny that the federal government puts on them compared to banks. where insurance companies have to have significantly more reserves to cover all the potential liabilities that they have out there compared to what banks are. So they're far safer places to keep your money in the first place. And so what we're able to do for people when we meet with them is if they really want to say, hey, I want to retire at 65, I'm 35 now, and I plan to live from 65 to 85, and I want to be able to have $100,000 a year to live off of, tax-free this way as well. So your money grows tax-free the way we teach it, and you can withdraw it as loans, borrow it against the death benefit of the life insurance policy as loans. And then we can go back and backward engineer the number and tell them, this is how much you have to put in today going forward so that you have that $100,000 to withdraw. And it's certain, and it's guaranteed in a contract with the life insurance. So it's not speculative, putting your money in the stock market and stuff. So that's what we talk about. And so that can allow people to have a tremendous amount of confidence in what they're doing and what the end result's going to be. And it makes them oftentimes work harder, like somebody that might be like afraid to put $10,000 a year away into their 401k because they just don't know how it's going to turn out or if any of it will be there when they get to retire. Where somebody in this model, because we can show them, and it's all built on the actuarial tables inside the life insurance company's plans, that they'll be more willing to do whatever they have to do to put $30,000 into a plan because they know exactly what they're going to have in the future by doing that. So they know that their effort will be rewarded and it won't be wasted and it won't just poof, go up in smoke like all my parents' friends when they went to retire. And that makes sense, right? You're much more committed to something if you know you're going to get there than if you start out on a journey and you're like, I don't know if we'll ever make it because we don't know the direction and we don't know when the next place is going to be that we can get water or something to eat. So their perseverance and their stick-to-itiveness and their conviction to follow through are just much, much lower when all those variables are there and there's all that certainty.
Yeah. It's amazing how when you talk to the ultra wealthy, the centimillionaires, and what's interesting is that I had one guest and he was saying right when his kids were born, he bought life insurance because that's when it was cheapest. And nobody wants kid to die, but death is 100% certain. Just
inevitable. Yeah.
So you might as well protect yourself and get that payout. And it's just interesting how the rich do things very differently. What's the point of investing $1 million if you can only withdraw 20,000 a year? And then you just
really right. Yeah. And then you'll die and you'll have never been able to enjoy that $1 million your entire life.
Yeah.
And it'll pass on to somebody else and the government will take half of it. The way we're teaching people, it really allows you to spend all the money you earn your entire life during your lifetime and leave it all behind at the same time to your kids and your heirs. So they speak nothing but good about you after you're gone.
Yeah. And meanwhile,
completely different concepts.
Meanwhile, the brokers and the financial industry is basically using that to trade and invest and speculate and lend out. And, and here you are toiling and saving and you don't get to enjoy it. So that's one key difference, which is
I had a friend tell me one time the reason they're called brokers is because they're broker than you are.
Exactly. Yeah.
They're following their own advice a lot of times.
Yeah. How can people tell us more about this idea of 401k? Because that was quite interesting. You had this idea with common misperception about retirement accounts. So I'm just curious what you have to say about that.
I think we covered some of them. And like I said, the amounts that they're going to save up. But think about all that money you save, scrimp, delay, deny gratification for all these years. And you save up this big pile of money that you'll never be able to ever use or spend or enjoy your entire life. What we're talking about is setting up a system where you'll be able to use the money continuously over and over. We're just talking about recapturing, recycling, and reusing the same dollars all over and over and over and over again multiple times. Because when you put money into a 401k, they basically, if you're 30, they basically make you lock it away for 30 years, put it in jail. So you can't utilize it, you can't access it. And if you try to, they're going to penalize you for it. And on top of that, you're going to have to pay all the taxes on it. What we're talking about with in our own bank is you're in complete control. You can make loans to other people. You can make loans to yourself. You determine the rates, the interest rates, the payback terms, all that stuff. and you don't have those rules and regulations. And really, Chris, to me, a lot of it's about getting as much of my dollars as I possibly can in a tax-free environment and getting the government the heck out of my hair.
Yeah.
And a lot of people, those 401ks don't realize that money is not actually even their money. Those are all FBO plans. And I know some of your listeners might be very savvy, but a lot of them might not know what FBO stands for. It stands for benefit of. So when you sign that 401k, it'll say for benefit of. This 401k is a government program put together for benefit of Christopher Liu or for benefit of Rob Scranton. So what does that mean? Ultimately, it's really not even your money. And most people don't realize that. In fact, during the Obama administration, that's just time-wise when that happened, there was a representative, the name escapes me now, but he was down on the floor of Congress and proposing. He got laughed out of the Congress. But the fact that somebody was even thinking that way is rather disturbing and scary to me in the first place. But he said, we have about this much money in national debt here, and we have about the same exact money in all these qualified plans that are run by the government through laws that were passed by us here in Congress. These 401ks, these IRAs, these Roth IRAs, all these stuff. Why don't we just take all the money in all these qualified plans and just put it toward the national debt and pay it off for the greater good and start over from scratch?
Yeah.
And they literally could do that with a vote inside Congress. And most people that are in those plans don't have any idea that's the case. And we're really lucky to still have the option to create this infinite banking system. I think it was for a while us and Australia, and now Australia's government has gotten rid of that because the governments don't like when they can't access people's money or take it or steal it or confiscate it or tax it. But thankfully, there's enough of our politicians that have these banks set up themselves. I know Joe Biden's got to the tune of several millions of dollars in his own banking system with these whole life insurance contracts himself. So I'm not as worried about our country doing it. But the reason that there's so many of those provisions that make these personal banks so effective and work so well is because they were designed and set up way before the Internal Revenue Service or the U.S. tax code was even built in the first place. So they had no way to ruin them, if you will, because they predate those things.
Yeah. Fascinating conversation. How can people contact you, follow you on social media, check out your work, etc.?
Yeah, probably the best place to get in touch with us is at our website. That's yourfinancialiq.org. That's yourfinancialiq.org. And we've got a really good masterclass training on there that they can watch if they've wanted to know more or learn more about what we call the infinite banking system, or go on to Amazon and buy a book that we recommend by Nelson Nash, and it's called Becoming Your Own Banker. But those would be the two places that I would say is to go on our website and watch that presentation. In fact, Chris, we'll even teach people how to buy all the cars they're going to buy, drive, and own the rest of their life and get all the money back as well as own the car. So if they're interested in watching that, I don't know how much of the money you've ever gotten back for all the cars you bought, driven, and owned in your life, but most people, it's not very much. But we'll show you exactly how you can get it all back in that masterclass.
Yeah, interesting. And for all the audience out there, let's thank Robert for coming onto the show. Once you get a good financial IQ literacy, it opens up so much possibilities, and all his resources will be in the links and show notes. And with that, thanks so much for coming on to the podcast.
You're welcome. Thanks for having me, Chris.